All right, welcome back, Failsafe investors. If this is your first time to my page, welcome to Failsafe Wealth, where we pretty much cover all topics right now currently in the stock market or everything that has to do with the stock market and pretty much try to build wealth, but not just any type of wealth, fail-safe wealth, wealth that you can maintain for the rest of your life and pass down through generations. That's what we're pretty much trying to do here. That is the main goal of this channel. So I'm doing a special series that I like to call Battle of the Brands, where I take two companies, analyze them individually. Generally, it's one company that I'm already looking at, and then I pretty much look at the competition or any company that's competing with the company that I'm already looking at. Because if you're going to look at any stock, you definitely have to look at what their competitors doing also and see what they're doing different. Even if the stock that you're looking at is in a better position, you still have to look at what the competitors are doing. So, like I mentioned in the last episode where I did a stock analysis on Procter & Gamble, a lot of people I've been hearing are thinking that next year will be a big baby boom because a lot of people are forced to stay at home. So I said, okay, I'll look into Procter & Gamble. You know, they sell like Pampers, Loves, and they cover pretty much a lot of household products that you pretty much need in your life. They are in the consumer staple sector. So in today's episode, I'm pretty much looking at their competitors, and there's a couple things I'm going to point out with this company. Without further ado, let's go. Let's go. So in today's video, we're gonna look at Kimberly-Clark. So like I mentioned in the last video that I did on Procter & Gamble, I said there's not too many stocks or companies, yes, stocks, we'll say stocks, that you can invest in that covers the field of pretty much babies, meaning like diapers and things like that. There's a very small portion of companies. Now, what I didn't know at the time, that there really is only two companies. So if you want to invest in stocks that cover diapers, you're either going to invest in Procter & Gamble or Kimberly-Clark. That's literally it. Now, there are other diaper brands. I don't want people just commenting saying, but I buy these brands and all that. Just because there is a brand doesn't mean that that company is public and doesn't mean that you can purchase their shares. Now, if I'm wrong, put a comment down below. Tell me what other companies that you can invest in that covers diapers. Specific product, diapers. We're not just talking about anything, but like diapers and things like that. Now, I know you can invest like Johnson & Johnson, and they cover products that might cover the subject of infants and babies and things like that, but we're talking specifically about diapers, because one thing that every child needs when they're born is diapers. Now, with that said, let's look at Kimberly-Clark. We're going to go with the same format that we always do. I'm going to give you the basic metrics like the PE ratio, the dividend yield, the earnings per share, the market cap, and the ticker symbol. Because like I said before, the stock price really doesn't matter. I don't look at that until like the end when I'm analyzing the company, because it's like once I figure out the company and what they do and do a fundamental analysis on the company, then I'll say if it's worth me paying that price for what this company can produce. So, Kimberly-Clark, ticker symbol KMB, has a share price of around $146 per share. Now, that is more than Procter & Gamble, selling at $138 per share, but Kimberly-Clark has a market cap of only $50 billion. Big difference, very big difference, right? So they have a market cap of $50 billion. They pay a dividend yield of 2.9, that's not bad, and they have an earnings per share of $7.45 with a price to earnings ratio showing the last 12 months of 19.86. Now that is pretty good for any company. That's a pretty solid number. And Kimberly-Clark was founded in 1872, making it a 148-year-old company. Been around for a very long time. Not to mention they have what is called royal warrants. Now, this is something that I didn't know even until I started looking into Kimberly-Clark. So, to put it simple, a royal warrant means that this company supplies the royal British family with some type of product or service. They do still get to charge the royal family for these products and services, but they also get to advertise that they service the royal family with their product or service. So they have been given royal warrants by Queen Elizabeth herself, because it has to be given to you by the queen or king at the time, no matter what family they service in the royal family. So even if they like do something for a cousin, a faraway cousin, unless the queen say that you can advertise that, you have to have a royal warrant. Now, if this is your first day learning this, welcome to the club, because I did not know this until I looked into this company. So Kimberly-Clark, like I mentioned, Procter & Gamble is the brand that brings you like Loves and Pampers, and then Kimberly-Clark brings you the brand Huggies and Pull-Ups. They both cover pretty much diapers. Now, 9 times out of 10, since these companies are so big and have been around for so long and established a big footprint on this like field or whatever, 9 times out of 10, if you go to Walmart, because I don't know exactly where you shop, you know, what type of diaper brands you use, if you have a child, this, that, or the third, but I'm saying 9 times out of 10, if you go into Walmart and you go down the baby aisle and you're going down that baby aisle for diapers, 9 times out of 10, you're gonna grab one of these 2 companies' products when it comes to diapers, pull-ups, anything covering that subject. And they also sell other things that has to do with babies in general, because like I said with Procter & Gamble, they don't just sell diapers or Pampers. So Kimberly-Clark doesn't just sell Huggies and Pull-Ups. They also sell Scott paper towels, Cottonelle, like toilet paper tissue, Kleenex, baby wipes. They sell a lot of products. Pretty much a well-rounded company. They've been around a very long time. Now, for this company to be 148 years old, to have a market cap of 50 billion, that says a lot about the company. This company should be, in my opinion, and I'm only basing my opinion off of the age of the company, not what the revenue that the company is generating or anything like that. But at that age and all the products and brands that you have, you're in the consumer staples like landscape, you should be in the hundreds of billions. You've been around long enough to establish that, at least at a bare minimum. Now they still pay a dividend that is good, and I think their payout ratio is under 60%. So that's pretty good also. Like I said, if you do look into a company that pay a dividend, try to make sure that it's a good payout ratio, not anything that's 120%. I've seen companies that pay 200% dividend payout, meaning like you're paying 200%, 100% profits, and 100% is something else. I don't know where that money coming from. It could be different for every company. But like I said, based on the years and the products that Kimberly-Clark sells and the reputation that it's built up, having royal warrants, being sold in over 80 countries with hundreds of brands and products under you, you should definitely have at least a bare minimum $100 billion market cap. Now notice I'm not saying stock price, because the market cap is really what matters. Like I said, Procter & Gamble had a market cap over 200 billion and the share price was $138. Kimberly-Clark has a market cap of $50 billion and has a share price of $146. It was the same thing with Coca-Cola and PepsiCo. PepsiCo had the higher share price but the smaller market cap. Coca-Cola had the smaller share price but the larger market cap. Market cap is always what matters. Remember that. So now, with all of that said, I'm going to give you the financial statements of this company, meaning the balance sheet, the income statement, and the cash flow statement. And I want to get your opinion on this company and what do you think about this company. Okay, so before we move forward into the financial statements, I do want to make a quick side note that Kimberly-Clark has posted a revenue of $18 billion in 2019, and I want you to remember that number, $18 billion 2019 revenue. Okay, so let's start off with the balance sheet. So with the balance sheet, like I mentioned, Kimberly-Clark posted a revenue of $18 billion. They had about 442 million, not billion, 442 million with an M, million dollars in cash on hand, with about 5 billion in current assets, meaning assets that they could liquidate within the pretty much relatively fast. You know, that's assets that they can get their hands on cash either within the next 12 months or even within a couple of days. That's pretty much 5 billion in current assets. But when you look at 6 billion And current liabilities, that is not good. And that's not good for any company. I don't care how old you are, like how long you've been around, what sector you're in. It doesn't matter. Having more current liabilities than more current assets is bad. That's bad for any person. Any person that has more debt than what they are bringing in and can make is bad. But like I always mention sometimes, the current assets can be less than the current liabilities as long as the total assets is more than the total liabilities, correct? And also the total assets has to at least be 2-to-1 to the total liabilities. So when it comes to total current assets versus total liabilities, Kimberly-Clark has $15.2 billion in total assets. That's their total assets, $15.2 billion. And $15 billion in total liabilities. That's not good. That's terrible. That's like very terrible for any company, especially when you're paying a dividend. I would look at this as a management problem. I wouldn't look at this like they are the ones that manage the company, which manages the money, and it is management's discretion if they want to pay a dividend. Now, I understand that they are in the consumer staple field, or I understand that they are in the consumer staple sector, which means that they have a product that everyone will need at some point in their life, but that's not no excuse because you have other brands that I've noticed when I looked into this field, like, diapers and all that are up and coming, like more earthy. The products are rated better on certain websites. So with that said, I would definitely say that this is a management problem and not a good problem to have because you're barely making it by, and one small speed bump can almost knock this company out based off of the balance sheet and how much cash they have on hand. They'll have to issue more debt. Now they do have assets to leverage the debt if they do issue more debt, but it shouldn't come to that, is what I'm trying to say. Now, when we look at the income statement, like I mentioned, they had $18 billion in revenue for 2019, and they were able to walk away with about $2 billion or a little over $2 billion in net revenue. So they had about $2 billion in profits, and you should do this with any company you look at. Always look at the past, 5 years, 10 years, as far as back as they'll let you look. So I use Fidelity, Yahoo Finance, and a company and a website called Guru Focus, Guru Focus, to look up most of my companies and do my research on. But Fidelity is pretty much a good source, and you can use it for free. All you have to do is open an account, and you can open an account for free. But Fidelity looks back 5 years. So from 2015 to 2019, they've made $18 billion in revenue. And even when you look at the net revenue, which is pretty much the profits, it's been up and down from $1 billion to $2 billion, pretty much. In 2015, they made $1 billion in net revenue, and in 2016 they made $2 billion, and in 2017 they made $1 billion. And so it's with you posting $18 billion for 5 years straight, that lets me know that this company isn't growing. It is that simple. They're not even averaging average results of inflation on the dollar. They're actually behind. I'm just saying that. Now, the good thing is that the cost of goods did not go up either. So in 2015, they were paying $11 billion to make that $18 billion. And in 2019, they paid $11 billion to make that $18 billion. But as far as the revenue growth, it's just not there for 5 years. 5 years in the best bull run in the market. The last 10 years alone was great for the economy and the stock market alike. And this company shows no return on investment pretty much. Now the stock price has been growing. I will say that about the stock price. The stock price got all the way up to 160 before falling down to 111 in March, and right now it's at 146, and is expected to get back up to 100 and maybe 165, which is its all-time high. But I need growth on the revenue. I need growth on the top line and the bottom line. I need the revenue to grow, and I need the net revenue to grow also. I need more profits if I'm going to invest into this company. Companies like this are companies that I try to avoid like the plague. I'm just going to say that. I try to avoid these companies at all costs. This is a bad balance sheet, a bad income statement. And do we really want to look at the cash flow statement? Do we really want to see how much they spend on capital expenditures? We can't end the video without it, but let's just see. Let's just take a guess and see how much they spend on capital expenditures and then how much in free cash flow that they have left over. So in 2019, Kimberly-Clark posted a number of $1.2 billion in capital expenditures, which is money that you use to expand the company, you know, things like that, keep the company running and grow the company. Now, when you take that $2.1 billion in net revenue and subtract that $1.2 billion, you're left with about $900 million of free cash flow. And that's money that you can pay out for the dividends and things like that. So with that said, I think I've already given you my opinion on this company. Yeah, I would avoid this company. We'll see which one will come out on top between Kimberly-Clark and Procter & Gamble in the final edition of Battle of the Brands. So I put these two companies head to head. And one of the questions, if you watch my series, you know I always ask value, and the way I define value is paying for this company at this price. What is the expected growth or expected return that I can get from this investment? So we'll figure that out next time on Battle of the Brands. And until next time, let's get it, let's do it. Hit the like button, hit the subscribe button, share the video if you can. I really do appreciate it. So let's go.